Hi. So in this video, we are going to talk a little bit about Infy's annual report and decode whatever information we can get from Infosys annual report for the year FY21. We are going to focus primarily on the excerpts from the FY21 annual report. Where can you find this annual report? You can find it on the exchange's website. So you can get it on the NSE or BSE websites. You can also get it on the company's investor relations segment on the company's website. Right? You can also get it on third-party websites like Screener, etc. Right? So what are the core components of an annual report? That's what we are trying to decode in this particular video. If you look at the annual report for FY21, there's this table of contents which is available, and the core segments that anybody as an analyst would want to kind of focus on would include these elements that are highlighted. So you want to read through the letter to the shareholder. Typically tells you about what the management is doing, what the management is thinking about what's going on, and their plans for the company. You want to look at financial highlights, because financial highlights kind of give you a sense of what's been the history of the company and how has that moved. You want to look at some of these annexure to board reports, because these reports give you a sense of a little bit of corporate governance around the company. Things like management remuneration, things like how many independent directors are there on the board of directors of the company, and so on and so forth. You want to look at the management discussion and analysis. This is the key and most important component for any annual report that you're reading. Primary aspect of what does a company do, what are the areas it works in, what are the plans, how much of business is coming from what segments, all of that is usually outlined in the Mdna, or management discussion and analysis, right? Then you have the financial statements. You have both the standalone and consolidated financial statements. Standalone would be for the parent entity and consolidated would be for all the subsidiaries put together as well, right? Let's try and understand what does Infy do. So when you read reports about Infy, the annual report outlines that there are two core offerings of Infy, and one of them is digital, second one is core. What is digital and what is core? So digital is the segment that works with end-to-end digitalization of businesses, and that includes consulting, for example, right? Core, on the other hand, is the older legacy work that IT services firms used to do. This would include segments such as application development and maintenance, proprietary application development services, application maintenance, network infrastructure management, support and integration. A lot of these services that historically the IT firms used to do, all of that is basically a part of the core businesses. They have outlined this in the 2018 annual report for the first time. Till this time, they used to sort of segregate the revenue in terms of services, consulting, and products. Since then, they started doing it in terms of digital and core. The definition of digital is that the framework drives outcomes for the clients across 5 areas: experience, insight, innovate, accelerate, and assure. We craft the way their customers experience digital solutions. Basically, whoever the client for Infy is, how their customers experience digital solutions, help their businesses gain insight from the data. So analytics is available there. Innovate with them in the world of vertical platforms and digital first engineering. Accelerate the core digitalization, so basically moving towards a tech enabled infrastructure for the firm. And assure means that help them to for them to establish digital trust. So the idea is to use analytics, the idea is to use data, big data, the idea is to use sort of digital technologies to ensure how this could go ahead and sort of create value for the customer of Infosys, who could then deliver value to their customers. So if it is a financial services firm, for example, if it is an auto major like, let's say, Daimler, Infy would provide services to this company so that their customers can get a complete holistic digital environment for the experience of the product or the service that they are buying. Right? That's the context of how digital works. Now, what's there in the letter to shareholders? Excerpts from that. So what segments are growing? Digital business is growing fast. This is now replacing the core segment to become a dominant driver of the business. Digital, typically because it involves analytics, it involves consulting, has higher margins that are available, and so consequently helps Infy improve margin. You'll see that digital business grew by about 29% and now accounts for 52% of the overall company revenues. This is in FY21 or 2021, basically 2020-2021, right? In the fourth quarter. So in the fourth quarter of the year, 52% of the revenue came from there. Roughly for the year, if you see, that will be about 48% or something. They had $14 billion of large deals. They continue to do well in terms of market share. Their operating margin spiked up to 24%, although this year had a certain set of advantage on account of lower travel costs as such. But that's basically something that has come out. They are generating $3 billion of free cash flow. That's roughly about 22.5 thousand crore rupees of free cash flow that is there, and out of that a lot of it has been given out as dividend and share buyback. So if you see, dividend and share buyback adds up to about 2.7 billion out of the overall data that is there. So Infy keeps returning a lot of money to shareholders over that period. Some operating metrics from the financial highlights of Infy. Right, so revenues are about 1 lakh crore. Revenue growth was 10% in INR reporting currency. Right, 24% is the margin, improved by 300 basis points. So last year margin was about 21%, this year is 24%. Free cash flow generation of 22,000 crore. Digital is 48% of consolidated revenue and has large cash balances and investments nearly to the tune of 38,000 crore. That allows Infy to keep that war chest ready in case they want to do acquisitions tomorrow. Right. Number of clients, all of that data is also available. Good growth in $100 million plus clients, the size of clients, and utilization levels are good. This is important to understand. Utilization levels are at an all-time high. Right, there's some other data points that are available. What is on-site mix, and so on and so forth. Let's try and understand that as well. Right, so the first thing that comes to our mind is what is utilization level. Utilization is calculated as the number of employees who are getting billed. Right, you will bill your employees to the client when you're providing them services, divided by the total number of employees who can get billed. Right, so let's understand this. How does an IT company work? Let's say Infy is giving services to a financial services firm. They are basically going to deploy a certain number of employees on that project. They are going to bill the customer or the client for these employees, right? On a per hour basis, per employee per hour basis, there is a billing rate that will apply. If you calculate it for Infy, the blended billing rate would be about, let's say, $35 to $40 per hour blended in India and outside India put together, right? If, for example, you want to look at how does the calculation of utilization rates works. If assume that the firm has 100 employees and 10 of them are in sales and support, right? So these guys who are in sales and support, they will never get billed. You can't bill them to the client, right? The remaining 90 are people who can work on a project and can get billed. Out of this, if 72 are getting billed, then the utilization is calculated as 72 by 90, sorry. So that's going to be 80% of the utilization that is going to come up, right? My bad, 72 by 90, that's 80% of the utilization that comes up. Lower utilization would mean that some employees are not getting deployed on projects while they still have to be paid salaries. Thus, higher utilization improves margins for the firm. Utilization including trainees for the consolidated firm has been about 80%. This is at all-time high for Infosys at this point of time, as we see, right? Then there's this term called effort. Effort is just the number of hours billed. So if there are, let's say, 6 employees in India and 2 employees in the US, total employees are 8. 8 employees billed for 8 hours each will be basically 64 hours. That's the total effort. Out of this, on-site effort is 2 into 8, which is 16 hours. Offshore effort, which is in India. On-site is at client site, right? So abroad. Offshore is in India. That is going to be 6 into 8. 6 employees into 8 hours, that's 48. So the mix is basically 25% and 75%, which is what we see here approximately for 2021, correct? Now revenue, however, remember billing rates, if your employee is sitting in the US, the billing rate would be significantly higher, right? Makes sense, right? So billing rates are higher in on-site regions. So while 25% of the billing in terms of volume hours happens on site, 50% of the revenue gets generated there, right? 50% of the revenue gets generated there. So effectively, because we said offshore effort was 3 times as compared to on-site, revenue is almost equal. That would mean that your billing rates for a person or an employee who's sitting in the US and getting billed there are much higher than what they are in India. But we have to see how that works, because salaries are rising and tech sector has to kind of see that how offshore costs come up in the next few years. Historically, offshoring meant better margins because you had to pay lower salaries in India, and so you could sort of improve the margin. That was the core business model if you think about it, right? However, salaries are increasing, so you have to see what's the cost structure as we go along in future. The company gives in the annual report details about currency wise revenue, so you know which is the currency they are most sort of exposed to. So as expected, US dollar is the largest because even region wise from North America they get their biggest amount of revenue. UK is euro is the second one, followed by sort of Australian dollar and then pound and all the others. If you look at geographical split, nearly 60% of the revenue comes from US, right? And India contributes a mere 3% kind of revenue for Infi. Rest of it comes from US, Europe, and the rest of the world that comes up. Segment wise, they have offerings in terms of various segments. You can go and take a look at it: financial services, retail, communications, manufacturing. They'll have sort of a breakup. Financial services customers are the largest chunk. Nearly 30% of their revenue comes from that, right? Look at some core elements of the report. So starting from financial highlights FY17 onwards till FY21, you'll see that while revenues were consistently growing, 68,000 crore becomes 90,000 crore in that period, profits were more or less stagnant from 2018 financial year to 2020. Right, 16,000 crore remained 16,000 crore. Only in the last year profits spiked up significantly. So that was one thing. They used to employ 2 lakh employees in FY17, roughly about 2.6 lakh employees in 2021. And then the data is available in terms of US dollar millions, and you could look at the details with that respect. Number of employees continues to grow, and that's a key driver because that's what you are really billing on. Profits were stagnant for the past few years, but then showed a good jump in the previous year. Let's look at the Mdna and some core excerpts from the Mdna when we look at it. Right, so you'll see that companies are rapidly adopting digital technologies to reimagine their cost structures, increase business resilience, customer engagement, and so on and so forth. So basically, digitalization is a core theme. The fast pace of tech change and the need for technology professionals who are highly skilled in both traditional and digital technology areas are the driving businesses to rely on third parties to realize their business transformation. So a financial services firm or a manufacturing firm finds it difficult to get direct tech talent, and which is why this outsourcing forms a big component of the overall work that comes out of that. Right? Companies details with respect to higher deal size, the total number of deals win. Their overall deal size win was 4 times of 2018 deal wins, right? So in 4 years they have basically in 3 years they have basically quadrupled the deal winning. So there's good revenue visibility in the future. Work from home at this point of time, majority of the employees, and this remember is as on March 31st 2021, majority of the employees continue to work remotely. As of March 31st 2021, 99% of employees had enablement of secure remote working environment. 96.5 were working remotely at that point of time. That obviously can reduce the costs in the future because infra is not needed. Employees can be hired irrespective of their geographical location in tier 2, tier 3 towns. That might be at a slightly lower cost as well. So that's an advantage that the company sees. One key point that the company outlines is that they expect intensified competition in the future. In particular, we expect increased competition from firms that offer tech-based solutions to business problems, so similar IT services firms. Additionally, insourcing of technology services by tech departments of our clients is another ongoing competitive threat. So an existing client could decide to do this in-house as well. So higher competition is expected in future. This would mean a pressure on margins. You have to keep this in mind that while 2021 was a great year, a lot of it, those margin expansion of 3 percentage points primarily to a large extent was driven by lower travel costs. Travel costs did not exist in 2021 or was a very small portion in 2021. That will open up again now. Right, so you have to see what margins do at that point. Then they have this segment where they talk about segmental revenues. So, financial services, retail, communication, energy, utilities, manufacturing, high tech, life sciences, where is the revenue there, and what kind of margins they are looking at. So for example, while financial services has the highest revenue sort of composition, the margin is much higher in retail. The companies that are in the retail space, right? The growth could be significantly different in different segments as well. So growth in high tech, for example, was 53%, right? Growth in life sciences was 50%, although these are at a smaller base as compared to some of the other areas, but that's the scenario. What is to be pointed out, operating margins have increased across most segments. Revenue is highest in finance, high tech, life sciences. So you could look at end customer industries or consumer industries and then try and understand what's really happening there. Margin is highest in retail segment, and operating growth, income growth is highest in high tech segment, right? A quick point on corporate governance. Infi has nine directors on the board of directors. 6 of them, which is 66%, are independent directors, right? Independent directors are people who don't have a direct position in the firm or are not directly related to people in the firm. Why is that relevant? Is because board of directors is supposed to safeguard investor interest. Independent directors help you with that, right? That's assumed that independent directors are better. Some details with respect to historically what used to be the data. So 2018, you will note in the consolidated revenues, only about 25% of the revenue was digital. 2021, 3 years from here, digital is now almost half of the revenue. So significant growth in the digital segment that we have seen. Utilization excluding trainees, right, that we see in 2018 was at 84%. And that's been the number even now. If you see, that increased from 77 to 84 in 2018. And if I go back to the slide on utilization, you will note that utilization excluding trainees for the last 2 years was also 84%. So it seems that somewhere around this 80 to 84% is where utilization peaks for the firm and cannot go significantly beyond this. From here on, if you have to improve your profitability and margins, billing rates will have to go up, right? Or cost structures have to go down. Utilization may not be your primary driver for revenue growth for somebody like Infosys. The company plans to return or distribute 85% of the free cash flow over a 5-year period. So if over a 5-year period the company is making $15 billion of cash, free cash flow, they are going to return 85% of that in the form of dividends or buybacks. That is going to happen. This may be a conservative approach that can also limit future growth. It seems like Infi does not see massive big opportunities where they can deploy this particular cash. It seems like they will also believe that investment opportunity in business is not bigger than $2-3 billion over the next 5 years or so. So that's some data points that you can kind of find out with respect to Infi and its report. That's broadly it from me in this particular video. Do pick up any annual report, go through these segments and try and identify what are the core components of that. Pick up some other firms in the IT sector and try this out yourself for, let's say, a TCS or a Wipro or an HCL Tech, and see what data do they give, what commentary do they give about what their business is doing. That's broadly it in this particular video. If you have liked the video, please don't forget to share it and subscribe to our channel. Thank you.